Okay, so when you hear the name Meta, your mind probably jumps straight to Facebook or Instagram, maybe WhatsApp, right? But, underneath that social media surface we all know, there is a massive, and I mean massive, shift happening. The company is basically transforming from a software giant into something, well, something totally new, an industrial scale compute company. So in this explainer, we're going to break down this incredible pivot and, more importantly, what it means for anyone investing in the company.
Right. This whole transformation, it really starts with the money. And we are talking about an almost unbelievable amount of it. The whole story is really written in the language of capital expenditure, or CapEx for short. And as you're about to see, Meta isn't just spending more, they are completely rewriting the playbook. So this is where it gets kind of wild. Just look at this chart. The projected spend for just the third quarter of 2025 alone is staggering. We're talking an estimated $18.8 billion. To put that in perspective, Meta is planning to spend more on its infrastructure in 3 months than it did in the entire year of 2019, 2020, or 2021. This isn't just a little bump up. This is a completely different scale of investment. And that really brings us to the core question we have to answer here. Why on earth is a company that's famous for code and clicks suddenly spending money like an old-school industrial giant? What is going on? Just let that number sink in for a second. $18.8 billion in one quarter. If you can understand the why behind this one single number, you've pretty much unlocked Meta's entire strategy for the next decade. So, the next logical question for any investor has to be, how can they possibly afford this? I mean, this level of spending would absolutely crush most companies. But of course, Meta isn't most companies. Let's take a look at the financial engine that's making all this ambition possible. And here's your answer. You see, Meta's core ads business isn't just doing well, it's an absolute financial fortress. After that year of efficiency back in 2022, revenue has just soared. It's projected to hit $164 billion for 2024. And look at those net income margins. They've snapped right back to a stunning 38%. This is the war chest that is funding this entire pivot. And look at how they're putting that cash to work. Even after spending a jaw-dropping $37 billion on CapEx in 2024, the company is still projected to generate $54 billion in free cash flow. Now, this is crucial for investors. They're using that cash to be incredibly shareholder-friendly, returning over $14 billion in just one quarter through stock buybacks and their new dividend. This is a company that is just firing on all cylinders. For any investor, you know that free cash flow is one of the truest signs of a company's health. It's basically the leftover cash after you've paid all the bills and reinvested in the business. And Meta's FCF is just enormous, which gives them this incredible flexibility to make these huge strategic bets. Okay, so we know how they're paying for all this. Now let's get to the really interesting part, the why. This spending isn't just about supporting their current apps. No, the infrastructure itself is actually becoming the product. And this is the grand vision. It's a massive initiative they're calling Meta Compute. And the goal is, well, it's just mind-boggling, honestly. They want to build out tens of gigawatts of computing capacity by 2030. But what does a gigawatt of compute power even look like? This slide right here really puts that goal into perspective. A big, typical data center campus that operates in the hundreds of megawatts. Well, 1 gigawatt is 1,000 megawatts. That's roughly the same power output as a full-scale nuclear reactor. So when Meta says they're planning for tens of gigawatts, they're talking about building the power equivalent of dozens of nuclear reactors just for their AI ambitions. This is a completely exponential leap in scale. And hey, this isn't some fantasy on a whiteboard. They are actually making this happen right now. Meta is already securing huge amounts of steady, baseload power by partnering directly with energy producers, including nuclear power companies like TerraPower and Oklo. They are literally taking themselves off the public grid to power their own AI destiny. You see, in this new world, if you want to be an AI leader, you have to control your own power. So what's the end game for all of this investment in power and data centers? It all leads to one single strategic goal: building a permanent, untouchable competitive advantage, something we can call a sovereign moat. This chart, this is the entire thesis in a single picture. Some analysts are calling it the investment jaws. Just look at how that red line, CapEx growth, is dramatically pulling away from the blue line, which is revenue growth. Now, this isn't a sign of trouble. It is a deliberate, strategic choice. Meta is choosing short-term pain, scaling its infrastructure way faster than it can make money from it, all to build a dominant, long-term position in AI. And this slide shows you exactly how that moat gets built. It's through what's called the sovereign stack. By owning every single layer, from their own energy to the industrial data centers to their own custom MTI AI chips, all the way up to the AI models themselves, they're building a massive defense for their future profit margins. Think about it. They won't have to pay that cloud rent to competitors like Amazon's AWS or Microsoft's Azure. They will own the entire factory, from the power plant all the way to the finished product.
So all of this incredible transformation, it creates a really fascinating challenge for the market. I mean, if Meta is no longer just a software company, how in the world are investors supposed to value it?
This slide just illustrates the conflict perfectly. Do you value Meta with a high software multiple, the kind you give to high-margin, asset-light businesses, or do you use a lower utility multiple, the kind you give to companies with huge physical assets and massive CapEx bills? The reality is, Meta is becoming a hybrid, a software company on the front end with a heavy industrial company on the back end. So let's just summarize the outlook for investors here. First, the financial health is rock solid. The company has the war chest it needs to fund this entire pivot. Second, the new normal, for probably the next 3 to 5 years, is this investment jaws period. Expect CapEx to keep growing faster than revenue. And finally, the long game is crystal clear. Build a permanent competitive moat through this vertical integration of energy, compute, and AI. And that leaves us with the critical question that every investor has to grapple with. As Meta finishes this staggering transformation into what is basically an industrial AI utility, is the market truly appreciating the long-term moat that's being built, or is it just getting distracted by the short-term spend? And that, right there, is the multi-billion-dollar question you have to answer.